Joe is the store manager of Maisha Bora Enterprises and has been instructed by management to provide them with the amount of inventory in the form of spare parts that is considered to be obsolete. Joe is at his wit's end as he tries to determine the basis to use to arrive at that balance. He proposes to consider spare parts over 4 years old to be obsolete. His boss Jeremy, however, thinks that it should be spare parts that are over 7 years old. Many account balances and transactions in the financial statements cannot be reliably measured and are consequently estimated. Examples of such account balances and transactions include bad debts, the useful life of non-current assets, provision for obsolete and slow-moving inventory, fair value of financial assets, and depreciation. ISA 540 states that the objective of the auditor is to obtain sufficient appropriate audit evidence about whether accounting estimates, including fair value accounting estimates in the financial statements, whether recognized or disclosed, are reasonable and that related disclosures are adequate. IS 8 also requires the basis used to calculate estimates to be reasonable. Accounting estimates that have material balances generally represent a significant risk of material misstatement if the degree of judgment and estimation involved is high. Management can also easily manipulate accounting estimates in order to arrive at the desired results. Let's look at an example. Furaha Bank has net loans to customers balance of 300 million. Balances that are overdue by more than 180 days amount to $2 million, while balances that are overdue by 90 days total to $6 million. The bank made a profit of $5 million before deducting provisions for non-performing loans. The bank is required to estimate a provision for its non-performing loans, and this should be charged against the profits. If the bank decides to provide for balances above 180 days, the net profit will be $3 million. If it, however, provides for balances above 90 days, the bank will incur a loss of $1 million. Management may therefore lean towards providing for balances above 180 days if they expect to receive bonuses on any profits made. It is this risk of material misstatement due to the lack of precise measurement that makes accounting estimates a key concern for auditors. So what steps should the auditor take when auditing accounting estimates? Firstly, the auditor should seek to understand what the requirements of the accounting standards are regarding that estimate. The auditor should then review the process that management used to identify transactions and account balances that need to be estimated and how the estimate was arrived at. The auditor should then review the process and model used to arrive at the estimate and the assumptions made. The auditor should then assess whether the model was consistent with prior years and whether the estimates are reasonable. The auditor will finally also assess whether management have considered and calculated the likelihood of misstatement due to the inherent lack of a precise method to measure the account balance or transaction. This likelihood of misstatement is referred to as the estimation uncertainty. To recap, accounting estimates pose a significant risk of material misstatements, particularly if the amounts are significant and there is a high degree of estimation and judgment involved in arriving at that balance. The auditor is required to gather sufficient and appropriate audit evidence regarding estimates. The audit procedures will include reviewing the process and model used to arrive at the estimate, assessing whether the model is consistent with prior years, and assessing whether the estimate appears to be reasonable.